Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. In this episode, we're going to be talking about the year 1913, what happened and why it's important to you and to your family. Rob, John, how are you guys this week?
We're good. Doing good, guys.
Yeah, I'm getting back into running. Even though it's still freezing outside, I took 35 days off, which for me, I love running. That's like, what fuels me. It's a really good reset for most days. And I've been just like chomping at the bit, and it's nice to finally have like slightly warmer weather. It's like in the high 20s. And yeah, it's been a nice kind of change of pace. So
Yeah,
that's what's new for me.
good. Yeah, lately I've been thinking about maybe a future business acquisition. So stay tuned if that ever amounts to anything, but it could be an exciting new move. All right, guys. Well, in this episode, we're talking, as we said, about the year 1913. Why is it so pivotal and impactful to our lives? And so why don't we go ahead and just kind of cue this off as a quick overview of 1913. There are three major highlights that we want to bring to everybody's attention. They are the creation of income taxes, the creation of the Federal Reserve or the central banking system, and also the creation of a home mortgage. So Rob, why don't you go ahead, cue us off a little bit, talk to us about income taxes and the Revenue Act of 1913.
Well, I think also it's kind of the timing of this is pretty good because it's pretty topical. So we're recording in early 2025. President Trump was just reelected, and he's been talking a lot about 1913 in these last couple weeks. And he's just talking about income taxes. He's I think he's floating out this idea of potentially reducing or eliminating income taxes. I'm not quite sure what his purposes are, but 1913 is coming up a lot. And he's talking about tariffs versus taxes. And so in 1913 was when the Revenue Act was passed. It was a 1% tax, and it was the start. We didn't have income taxes up until that point. And so that was a decision made. And actually, we'll be talking about a lot of these. 1913 was real kind of an impactful year for American financial history, and where the financial institutions really started their first steps of applying control to Americans in terms of taxation. And that ties in, I'd say, to this idea, the infinite banking concept and the idea of creating your own family banking system, because that's the kind of the point of all of this, is that once you create your own family banking system through early cash value, dividend paying whole life insurance, you can start to break free from these institutions that have been applying this control in increasing manner over all these years. But I'm looking forward to this conversation because this is the start. 1913. We're going to dig into the details of that either today or later. But yeah, it kicked it all off.
Yeah, Rob, this series we're calling Unveiling Institutions. And I find that to be so compelling. There are so many things that I've learned within the last probably 3 years and that I never was taught. I don't think anybody is going to be taught this information, but really does expose the impact on our lives, like on a day-to-day basis. And then most especially thinking in our family context, like generationally, how we can escape the grip, like you're talking about, Rob, of control that these institutions, and mainly we're talking about the banking institutions, the government, and corporations even are kind of wrapped up into that. But knowing that that not everybody is out for, uh, for your good. That maybe there's some people out there who, especially historically, are taking actions for their own profit and for their own benefit, and just to maybe maximize their own wealth and at the expense of others. So I think that's very realistic. I don't think it's cynical. I don't think it's, against human nature. I think that's just part of life, and while we're here on this side of heaven. And so it's just fascinating. It's something that I think everybody should at least know about, if not take action. And that's where infinite banking comes in, is where we not only get the education of what's actually happening behind the scenes in banking and institutions, but also how we can take action to have the best solution to address that.
Yeah, when I think about taxes or income taxes in particular, it's always eye-opening to consider how much of your own personal wealth is gone poof in the form of taxes. Probably, I'd say for most people, it might even be between 30 to 50% of your income could be distributed in the form of income taxes, or just taxes in general. Social Security tax would be included in there, gasoline tax, property taxes, sales tax, you name it. There's a tax for everything, right? The government is getting their cut first. And of course, there are good things that come from it. But their studies have shown, and I think Rob, you'll talk to us a little bit more about the Laffer curve in a second here. Is there an ideal tax rate, and what can we do to try to reduce our tax burden? That is what sophisticated, wealthy individuals are focused in on, is how can I eliminate what I'm paying in taxes? I mean, imagine, you come across this in the news from time to time of some successful investor, and he paid $0 in income tax that year, and people get fed up and throw their hands up in the air. And I say, good job to that guy, because he's clearly doing something right. That we should always try to move towards a system, or coordinate our finances in a way that we're going to get the best possible outcome for us, not for the banks or a different institution like you're talking about, John. But to be wise and prudent means to, take our best interests at heart, because nobody else is going to do that to the same level and extent that we can. But just to think about this historically speaking, what were the taxes that the founding fathers of America were fed up over? 2% on tea or stamps, or, those are kind of silly numbers for us to even consider. And they fought a war over it. And here we are facing 30 to 50% taxes. And it just seems like everybody is okay with keep going in the same direction. Why do we need to stir the pot? And if you don't do something to either eliminate yourself from that system or to mitigate your tax burdens, the amount of wealth that you're leaving in the hands of the government is astronomical when you're thinking across multiple generations.
Yeah. Like the question that you asked is, how can we reduce our taxes? But really the question that, even zooming back further, is like, are income taxes even necessary? Like 1913 is not that long ago in the grand scheme of things. Like before that, our country had a surplus. Our country was doing incredibly well financially speaking, and revenue and funding the government. Yet now we're at a $36 trillion deficit, and only getting worse, and over a trillion in interest. But yet we're supposed to be bringing in more income or more revenue from the income tax, which just real briefly, like, what was that first tax that Americans received? Right? It was barely like 1 to 6%. Like 6 was by far the max, and they said it would be, I believe it was 7 years was
7 years
to fund World War One, right? The Great War at the time. So to think about like that being a drastic measure at the time, and then fast forward 100 plus years where we are now, it's become a something that we're dependent on and can't seem to escape out of. So, and then, Rob, I'd love to hear your thoughts on the Laffer curve and just how that affects, uh, you know, personal wealth, overall economic impact. And that was fascinating to me when you were talking about it.
Yeah, I'll break it down in more detail in a future episode with some actual like, some charts. But the net effect of it is when when you studied Laffer was the last name of an of a economist, and believe it was in the Reagan era, and he studied taxes over time and revenue based on taxes. And the higher, what he noticed is that when you start to get into the really high taxes in the, I don't know if it was the 50% range or so, that the amount of money that would be given to the government and the amount of money that was being taken away from the individual, they didn't equal. There was actually the government would get less and the person would get less. The net was less for both. It was like money just literally disappeared from the economy. It just went to tax, went to nowhere. And if you actually dropped, there's a sweet spot for taxes. I think it's 12%, I think was kind of the sweet spot where the government got the most and the individual gave the least. But it was really fascinating that the higher you get taxed, the government taxes people, it literally just starts to destroy money at a certain point. And it's like so obvious, like, why would you do that? But, you know, let's not give the government any credit for being smart about things, right?
Yeah.
Um, and then to go back quick, like to what you're saying about early in 1913, we're hearing it in the news about tariffs and from that, what was history shows that from 1870 to 1913 was like the richest, relatively speaking, time in American history, that we had so much money from tariffs that they actually created a commission to determine what to do with all this money that we had, because we had so much money we didn't know what to do with it. So I think the summary there is that is like the taxing people, taxing is not the solution. And so that's kind of the interesting concept, is where to come from. We're going to talk about that a little bit, 1913, but why? And what's the motivation? Like you start to get the sense that it's not for the benefit of the government even necessarily. It may be more for the benefit of the bankers, right? And so it's just, yeah, it's interesting delving into the history of taxes. And the thing that really attracted me, and one of the many things that attracted me to mutually owned dividend paying whole life insurance, it's at least a simple thing I can do as an individual. I'm not an elite. I'm not in Washington. I don't rub shoulders with anyone special.
Yeah.
It's a way that at least it's an action I can take in my family to hedge against inflation, to create a tax-free, a tax-deferred, but if used strategically correctly, in effect, a tax-free system to have income and to pass on legacy to my family, because the government wants to get you on the front end and the back end. Well, with life insurance, you can help to at least insulate your family a little bit from that, start to break free from the banking systems and the institutions and take that control back. And that's what really attracted me. It's just a simple thing that anybody can do. You don't have to be rich and powerful. It's for everybody. And it's such a powerful tool that we're just trying to share with people.
Yeah, and our last episode was about what would the Rockefellers do and the eroding factors that reduce generational wealth. And I know we're talking about 1913 was the start of income tax, but just the estate tax of 40% and how
Yeah.
much of an impact that can make for generational wealth, especially for the wealthier, families out there, that really does erode significant wealth, over time. So.
Yeah, and not to say that we love everything about the current administration, but if things are successful in the way that they're talking about, eliminating income taxes and sheltering your wealth through life insurance and a family trust, that in itself, you're reducing the front impact that you're talking about, Rob, and you're eliminating the back end impact of wealth transferring, and that would be a crazy impact for people's finances in the here and now. Being able to not pay income tax, save your money, your dollars inside a life insurance contract that's growing tax deferred, accessing if you need to, tax-free for retirement or passive income, passing it on to your family, estate tax-free, rinse, recycle, repeat. Like that's some crazy afterburners that us as US citizens have not enjoyed since before 1913.
Great.
So let's move on. Let's talk about the next event that happened in 1913. John, why don't you discuss a little bit about the Federal Reserve and the creation of a central bank? What happened, why it's important to our listeners and to us as individuals.
Yeah, so a great book that I would recommend. It's a little conspiratorial, honestly, for my taste, but it's still, I think, just fascinating and does just share plainly fact. Is called Creature from Jekyll Island. And it describes the creation of the Fed, the history of the Fed, and also goes into what our country has kind of tried and failed before the creation of our current central banking system. So to just briefly zoom out a little bit, a central bank is one, like it's called the Federal Reserve currently. And I think the book is clever in the way that it says it, where there's nothing federal about it and they have zero reserves, right? So it's not a government agency. It has nothing to do with the government, right? They're not government employees. It is technically a private bank that happens to have an incredibly tight relationship with the government, and they work hand in hand. And like America has tried central banking three total times. We're on our third try, essentially. And two times before that, it failed, right?
Yeah.
There was hyperinflation, there was all sorts of, economic booms and busts that we apparently didn't learn from. But regardless, in 1913 and slightly before that, the book Creature from Jekyll Island talks about events that led to the creation of the central banking system that we currently see today. And for starters, it was a very small, incredibly wealthy group of men who seemingly formed the idea of what it would look like, right? And among that group were ultra wealthy bankers. There was even someone, from Europe from Germany, who took the format that they used in Germany at the time, which by the way failed like 20 years later, of how to create a central bank. And they devise what we now see as the central bank, as the Fed. And uh, they set monetary policy, right? So they set, banking industry wide, like, interest rates, for example. That's something everybody cares about. There's, meetings I think there's 8 meetings a year, if I'm not mistaken, where they set the federal funds rate, right? And since 1913, right, before we were talking about a surplus, we were talking about economic prosperity almost, and there were some, periods of where not everything was just, butterflies and rainbows, but after 1913, things really started to shift, right? And then we saw things like the Great Depression, and we saw event after event, which we'll get into in this whole series where we're unveiling just kind of what these institutions do. And primarily we believe that, the Federal Reserve was created in the interest of profiting banks, right? If you think about it, uh, the Federal Reserve Act like talks all about like it's in the Americans' best interest to have this lender of last resort, to not allow a bank to fail, right? We don't want to lose our deposits and so forth. But really, like in the end, who's actually profiting? It's always the bank. The bank always, always, always wins in these situations, um, to where, these massive banks are too big to fail. I think there's a book called, Too Big to Fail, that no matter if they're irresponsible with the deposits that they receive, with the loans that they're making, they're going to be bailed out some form or another. So we can get on a different episode just far, far more in the weeds of what is involved with the federal bank and how it impacts us today and how it has impacted us over the last 100 years. But 1913 was incredibly significant, and the Federal Reserve was a huge reason for that.
Yeah, I think the two great evils of a central bank are the ability to print money to increase the money supply and fractional reserve lending. Those are the two great catastrophes that happen when you have a central banking system. And the reason why those are both so bad is because that's what causes inflation. If you can just print money willy-nilly, like they did back in 2020 and 2021, where you're just sending money back to the people, and everybody thought, oh, this is going to be great and grand. And now we're living with the consequences of that action with record high inflation and people struggling to even consider home ownership because home prices have gotten so high. And because of fractional reserve lending, that's one of the reasons why mortgages are so crazy, stinking expensive. Just that the purchase price of homes goes up because of fractional reserve lending. And that's the ability of the bank to take what they have on deposit and loan out more than what they actually have on deposit or in reserve. It's a way for them to leverage what they currently have, sometimes 10 to 1, if not even more. I forget right now, but I think the Federal Reserve may still have um, released the reserve requirements of other banks in the United States. And so they could loan out 100 to 1 if they wanted to, if not more. So that's crazy what that does to an economy and causing prices to go up. And then, of course, you as the borrower are now tied to that lender and having to pay and service the interest expenses, which can eat people alive. And it does, sadly speaking. So, yeah, Rob, any other thoughts on the two evils of a central bank?
No, I mean, I think you kind of covered it there. I mean, I just think it's when I first learned about what fractional reserve lending was, it blew my mind. And I don't know, I'm assuming not a lot of people know what it actually is. Like you said, Derek, where a bank it gets a deposit of $100,000, it can lend out up to $1 million or more. Like there used to be limits on what they could reserve. They had to hold X amount of percent in reserve in actual cash on hand in the bank. But due to COVID and whatever, other other decisions that was lifted to by the Fed to try to spur on the economy. But that just not only does the Fed print the money, but then it gives it to a bank and a bank can then just lend out what they don't have. Like just think about that. They're lending out what they don't have and gaining profit on it. Like that's a great business model, right? And so that's just something for folks to be aware of. And that's why, the idea of becoming your own banker, starting your own family, system through your whole life policy. That's like a place that you can go to if you needed to to get a loan. You don't have to go to a bank. If everyone starts to do that, it starts to reduce the power of the banks over society. And that's kind of the grand kind of the vision, or one of the benefits of the privatized banking. In a sense, you're privatizing it. It's your own private system that it starts to the grip and control of these institutions over normal everyday people lessens because you don't have to go to them hat in hand if you have an emergency and you need funds or you need to buy a vehicle or whatever you want to make an investment. So that's kind of the why, one of the whys behind why we got into um, infinite banking or getting these early cash value whole life policies is that freedom and that control and those guarantees that you get. It allows you to recapture some freedom that you didn't have before that I wasn't aware of. That's why it's such an epiphany when I first caught the idea through Nelson's book, Becoming Your Own Banker, and here we are today.
Yeah, have you ever heard someone say, I'm sure you have, where it's like, oh man, I've banked that, or like
Mm,
that's in the bank, as though
mm,
that's like a synonym for a secure storage place. But we've talked about the inflationary impact of fractional reserve lending, where that 100,000 being able to lend out 1 million that just created out of thin air $900,000 extra into the economy. which in and of itself is inflationary, which means higher prices, right? But then you think about the flip side of the coin of how it impacts us as the depositors, as the people who store our cash in these banks. And everybody's like, I think we've seen it many times where we see banks fail. Silicon Valley Bank was one of the most recent ones where, a run on the bank can happen where banks can be on the hook for, we'll call it, $1 billion of deposits, right? But they really only have probably like 10 million or something, just hardly even close to that 1 billion. And say all the owners of these deposits cash in and want those deposits withdrawn, they can't even get close to that $1 billion that they're on the hook for. And so that means like calling it in the bank is one of the least secure ideas. I laugh every time someone says that,
Mm-hmm.
I banked that away or whatever. Like it's just not even close to being a correct description of what someone's trying to say. So for me, I want to know that if I'm, wanting my $1,000 or $10,000 or 100,000, that it's actually there, right? And that's what we love about life insurance companies. They cannot, by law, inflate the money supply. They can't lend out anything more than what they have in reserves. Like it's all 100% of what they have in reserves and available to them. So uh, that part of control and security, just goes an extra level for me, knowing that there can't be a run on a life insurance company. Like they're just very, very conservative, wise, and they don't lend out 10 to 100 times of what they have in reserves just for this, infinite profit. And it also just rubs me the wrong way every time when I think like a bank is the one like who can foreclose on your home, who can control many near and dear aspects of your life with money they don't even own, they don't even
Yeah.
have, right? They have so much control with infinite profit on money they just do not have. And it all, I believe, traces back to this 1913 creation of the Federal Reserve to enable, equip, empower them to do these, I believe, unethical practices with our money, right?
Yeah, well said.
Mm-hmm.
Well, guys, we have one more big impact item that we want to touch on here when we're thinking about the year 1913, and that's the creation of the home mortgage. John, why don't you go ahead, give us maybe a little bit of context as to what happened or what was available before 1913, and is maybe even making a little bit of a resurgence in the U.S. But why is the home mortgage a bad idea for some people?
Yeah, so the home mortgage really only benefits the bank, right? It is a very bad deal for the consumers like us, right? If you think it's a 3% rate or back in 2020 or a 6%, like it's not actually that. If you think about the total interest, and many people know this, but not many people, feel like there's any other way out of it, that over 30 years, you're not just paying 6% on, say, a $500,000 house, right? You're probably paying, and everybody's, I think, heard this statement where you're paying for the house and you're giving the bank a house as well. Like your total
Mm-hmm.
interest is probably 100% or close to that, even on a 3% mortgage, right? And so the creation of this in 1913 created this rigid, like segregated loan that means that it's only there, you can only input into it. You can't take anything back out of it. If you want to take back out of it, then you have to come come hand in hand for another loan, aka a
Mm-hmm.
HELOC for most people today, just to get access to that equity that you're building up and that you're working hard to achieve, right? And so before that, most people had two-way lines of credit, right? Like just like an operating account where that's where they paid their bills from. That's where they uh, also, financed their homes. I do think historically there were much larger down payments on property and homes. Uh, you know, Generally around 40 or 50%, I think was pretty common of a down payment. I think that's indicative of people were just uh, better savers back then, right? They weren't as dependent on debt. And I believe that's because of the banking system that we have today. right? Like the national savings rate, I believe right now is 3.5, almost 4%, where back then it was around, 12 to 15. So knowing that banks now have a huge like arm of control in our lives if we want to be homeowners. If we want to own a home and try to build generational wealth, and not even mentioning just all the heinous like segregation and different discrimination aspects of that, like even if you had access to this mortgage, it still was a terrible deal for us because we would be paying far more in interest, especially in the upfront years, than we otherwise would have to, right? And there's now ways today to say, replace a mortgage with a HELOC, right? And have that be your operating account and try to reduce the overall interest that we're forfeiting to banks. And we're forfeiting it like at a guaranteed rate, right? And Nelson talks about this in Become Your Own Banker, that the first 5 to 7 years of a mortgage is like 88% interest, right? Uh, and what's the average time span for the average American family to move or refinance? 5 to 7 years. So then we just repeat the cycle of forfeiting to banks, primarily interest and not building up any equity or value for ourselves. So, tying these three together, in my opinion, does what Derek talked about in the beginning of this episode, that like it creates a level of control from these institutions to mainly just middle America, right? Uh, the ultra wealthy don't necessarily get mortgages, but the ultra poor also can't qualify for one. So it's all middle America who just has uh, this downward pressure from these institutions to make it really difficult to push past, right? To be, you know, constantly thinking about a mortgage to pay, constantly thinking about debt that we're owing, and inflation and income tax and all these things that are causing us to not be able to abundantly produce. I believe is by design by these institutions. Whoever was in charge in 1913, and we know some names around that time, I think was sinister, truthfully.
Yeah, the hard pill to swallow is, my own personal experience, right? We've been in this house for, it'll be 5 years this summer. And we get our monthly mortgage statement in the mail still. And, to see the loan balance has gone down $30,000, let's say, in those 5 years, which, is maybe a little more than 10%, right? So we have spent, more than 10% of our time paying this off. We've spent probably 20% of our time paying this off, but we've only paid down 10% of the principal outstanding on the loan. So it's hard to get ahead. And the interesting thing that Nelson did study is, it's very true. People either refinance or move in 5 to 7 years. Whereas if you structure, you do a first position HELOC or line of credit, like John has talked about, or sometimes referred to as an all-in-one mortgage, many people are able to pay off the home in 5 to 7 years. So you've got an asset now, or you've got at least home equity totally free and clear. And if you want to go and move, you can, but you're moving in a position of, now I've got a lot of equity in my home to go, and if I want to move into a larger house, I've got much greater equity than just the 10% that I've got now. That's crazy to think of. If I would have done this 5 years ago, we could have had the house paid off by now, rather than only having 10 to 15% equity in the home.
Yeah. So then people are just dependent on inflation to increase the value of their home.
Right.
Is a losing proposition in and of itself, to where if you want to move into the next home, it's going to be a more expensive home, or whatever else may be. That inflation is the hidden or silent tax, right? I think everybody knows this, but few people understand why, right?
Yeah. Yeah, it's a lot of people just they stay so focused in on just what a monthly payment is, And they do that not just for mortgages, but for cars and boats and whatever. Well, I can afford that monthly payment. And they don't stop to consider of, 85 to 87% of it is gone like that and is into the hands of the banker who lent it out on a fractional basis anyway. So he's making crazy amounts of money in those first 5 years to where you could have just had the home paid for if you would have just shifted your mentality and thought, okay, is there a different way to do it? Is there a different method that I can do or use to go about taking care of my housing expenses? I mean, imagine if instead of the 15% equity I have 100% equity. And now for the rest of my life, I can defer what I had been paying into whole life insurance and store that up. So by the time my kids go to purchase their home in 15 to 20 years from now, I've got more than enough accessible for now. I can be the bank. I can be the one who's got the line of credit for them through the hands of my life insurance company that I'm partnered with. And it's just a great way to alleviate pain and stress and anxiety from your life by being able to remove yourself from the system, these other financial institutions that don't have your best interests at heart, into a place where you've got complete and utter control and contractual rights and security, and being able to do it in a way that is out of the hands of the government from taxation as well. So you've eliminated all three of these issues that we've been talking about. And now you've created a system and a legacy in place for your family to do this repeatedly for the next generations ahead.
I love this stuff. It's like, I wish I would have known it so much, so many years before, but
Yeah, me too.
we're all just products of the best that we know. So we hope people listening to this can maybe have their eyes open a little bit more and be able to escape kind of the conventional losing proposition, unfortunately, that I was in, that many of us were in before discovering all this, that we can take action to change.
And so for our listeners, if you're interested in learning more, obviously we hope to have future episodes a little bit more targeted to these particular topics. But if you're interested in learning more about how to set up your own family banking system, I would encourage you to send us an email at thefamilybankingshow@gmail.com, and we'd be happy to sit down and schedule some time with you. Guys, once again, thanks for your help in this episode, and look forward to the next ones ahead.
Sounds good. See you guys.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.